But first, we have an earnings alert on Disney. The stock bouncing off after hours lows. The company just made a major announcement about its dividend. Let's get straight to Julia Boorstin with the details. Julia.
That's right. Disney CFO Christine McCarthy just announcing that Disney will be suspending the payment of its dividend in the first half of the year, which they say will preserve around $1.6 billion in cash. Now, this comes as the company announces that COVID-19 cost Disney $1.4 billion to its bottom line in the quarter. That includes a hit to advertising, movie delays, and of course, most of all, the closure of Disney's parks. Now, the Disney parks alone had an operating income loss of $1 billion in the quarter due to COVID, driving a 58% drop in operating income. Now, here's what the new CEO, Bob Chapek, says about the plan that he just announced to reopen Disney Shanghai on May 11th. Take a listen.
The approach we take may include implementation of guest capacity and density control measures, as well as health and prevention procedures that comply with state and federal guidelines. We are seeing encouraging signs of a gradual return to some semblance of normalcy in China.
The company talking about how before it began to close its domestic parks in mid-March, they had been seeing an increase in both guest attendance and guest spending. A lot of talk about how the Disney brand is strong, and they do believe that people will return both to parks and to theaters once things open up again. But certainly a dramatic hit from the impact of COVID. Back over to you.
Any mention yet so far on the conference call, Julia, about strategic investments and other cost cuts?
Well, strategic investments in terms of where they're making their bets right now, Melissa, they're talking a lot about the focus on streaming, the better than expected growth of Disney Plus, the success of their investment in original content for Hulu. And then, of course, the odd man out there in the streaming department is ESPN Plus, because there hasn't been any live sports for weeks and weeks now, though they did point to that Michael Jordan documentary and the success they found there, releasing that documentary early. But right now, it really seems like the bright spot is Disney Plus, which is certainly in investment mode right now.
Right. Julia, thank you. Julia Boorstin. Unfortunate, Guy Adami, that Disney Plus is the bright spot here, and Disney Plus is not where it makes money.
No. And if you listen, and hi, Melms, and if you listen to the great Tom Rogers, who was just on with Sarah and Wealth, he points out some of the headwinds facing Disney over the years to come based on exactly that, Disney Plus. Look, the stock, I don't think you're going to see that 79 level, which we saw on March 20th, but we have been talking about over the last couple of weeks that run-up off of the Disney Plus numbers was probably extended to the upside. And I'll say it again, I do think you're going to be able to buy this stock cheaper. We've been saying it for a while. Somewhere between 90 and 95 is where you get back in. I mean, the stock's down 54% now from the Thanksgiving high. Earnings are down, I think, 63% year over year. So the math sort of lines up. But there's just no real, in my opinion, I just don't see the catalyst to buy the stock right now in this current environment. So I think you wait and you buy it cheaper. And I think you're going to have that opportunity.
Already a couple of downgrades going into earnings, one from MoffettNathanson, which we've discussed, and the other from Rich Greenfield over at Lightshed Partners. And one point that Rich was bringing up was, here in this sort of environment, will Disney have to pull back on strategic investments? So pull back potentially on a growth business that, granted, is not making money yet, but streaming is the bet of the future, Tim. And so I'm wondering how you sort of see this conference call playing out. Oftentimes it is comments on spending, and in this case, maybe cutbacks in spending that could move the stock.
Well, what's really fascinating is that what was once an advantage over Netflix that Disney had, some of the strengths in their diversified business are really liabilities relative to Netflix. And so two companies that probably right now, and if not, 20 minutes ago, were the exact same market cap at around $183 billion. And Disney's strengths in studio and DTC, are really hurting them now as we look for the next couple months. And it is, Netflix was this big cash burn story, and Disney's now having to cut the dividend. We didn't think about the balance sheet in Disney ever. This was something that was actually some level of confidence. I like the proactivity on the dividend, but for a lot of investors, I think that's going to send a signal that liquidity was something we never thought about here. And all those things about the Disney, flywheel and ecosystem, however you want to phrase this, were advantages. And today they don't look great. I'm a shareholder. I think the market has priced in a lot of pain here, and it comes to what multiple you want to put on this company. If you're at a market multiple, this is a $110 stock right now. If you think we should be, a slight premium as it has, you can put a bigger number.
Suspending the dividend for the rest of the year, I mean, that does make you wonder what sort of liquidity issue they might be looking at if things continue the way they are in terms of the shutdown, Karen. But maybe this is just a very conservative move, and this is actually the smart thing to do right now.
I think it is. Did you say suspended for the whole year or for the first half of the year, which is what I thought? They only pay dividend twice a year. So I thought that was just for the first half, which would be, I think, $1.6 billion. But either way, I think it's the right thing for them to do. It is a little scary, as Tim said, for shareholders who have always thought of Disney as just rock solid and never really had to question whether they would have any reduction in their dividend. This is a little bit surprising, but I do think they're doing the right thing. I mean, you raise the money when you can, not when you have to. And we didn't ever think of their balance sheet until they did the Fox deal. And it turns out the timing of that was unfortunate when the rest of their businesses that they never could have foreseen all correlating to one or to no revenue, I guess, was happening at the same time. I think that it is getting a premium still in the market. We don't know what their earnings are going to look like. And to me, the question is, when do they return to whatever the new normal is? And what is the new normal for some of their businesses? I don't know. I mean, I love the name. I just feel like I agree with Guy. I think we'll get a chance later.
To clarify, the board is going to forego the next semi-annual cash dividend, so that they pay twice a year. So the next one will not get paid, and that will result in a $1.6 billion in savings. Grasso, where do you see the stock here?
There's no way you could talk around the void of over $26 billion in revenue that's absent from the park. So to talk about technicals within the stock, I think, first of all, when you look at the dividend, that's going to be greeted with a screaming sell tomorrow when the liquidity comes back in the marketplace. I think you're going to get a shot, as everyone else said, lower. How much lower can it go? I think we might see $92 tomorrow, so $7 lower than where you're saying it is. See it now. I don't think we're going to see that March 18th low of 79, but I think this stock can break 90 and be in the mid 80s. So I would wait, and I would be a buyer of Netflix off of this easily.